Most traders are constantly looking for a single trading strategy that will work all the time and provide them with that ideal smooth equity curve with a nice upward slope, irrespective of the current market conditions. This is a running theme among beginners who do not yet have that sufficient experience in this business and keep jumping from one strategy to another, hoping that the next one will be the one with which they will finally make it. But they're missing an important piece of puzzle here, which is that a single trading strategy is never going to be perfect, and that the key to a smooth equity curve that everyone looks for lies elsewhere. In this video, I will demonstrate that to you by showing you a simple trading strategy that on its own would not be really interesting to most beginners who would scrap it and go looking for something else. But then I will take that strategy and combine it with a different one to show you just how massively the performance improves by combining them, generating this bright equity curve here. My name is David from Critical Trading Channel, and if you've just come across this channel recently, I publish top quality trading content where I share systematic trading strategies, tips and my knowledge that truly helps you on your own trading journey. If that's something you're after, then subscribe to my channel to get notified when I publish a new video. For the purposes of this video, let's have a look at a simple strategy I've been testing and validating recently. It's a systematic trading strategy that trades volatility. Now, volatility trading is a great way to diversify your stock portfolio. In general, when the stock market falls and naturally causes long-only stock trading strategies to lose, volatility rises, and so the volatility is generally negatively correlated with the stock market. I've got a stock market represented here by the SPY, which is an ETF that tracks the stock market. We can see this huge dip in the beginning of 2020. We can see that as the stock market keeps falling and naturally results in various trend following systems to lose, the volatility spikes. This is visible in the graph plotted below the SPY, which is the VIX index that's widely used as a measure of stock market's volatility. Similar pattern can be observed during other less significant downturns in the stock markets. Going long volatility is therefore a good idea if one wants to hedge their stock trading strategy, which is exactly why I started to look into this myself. Now, the actual strategy I will use for the purposes of this video trades VIX futures, which is what we're looking at on this screen here. Very briefly, this strategy buys the VIX futures when the market closes above the top Bollinger Band, plotted in purple color on my chart. So buy setups got generated here, here, and also here. Strategy closes its positions on first day up after the entry, or 4 days after the entry, obviously whichever comes first. Alternatively, VIX can be traded via ETF as well, ticker VXX. However, this is not tradable from Europe at the time of making this video, and so I'm using futures. So let's have a look at the strategy's performance. Equity curve looks as follows. System definitely has an edge, but clearly its trade frequency is too low. We can see periods where the system is inactive and the equity curve goes pretty much sideways, which is then followed by significant run-ups like this particular one here. The average annual return of this strategy is just at over 16% after trading commissions have been deducted. The maximum drawdown of this single strategy is at just over 31%. Now, looking at the monthly profit table, we can get a very clear picture of the risk profile and the characteristics of the strategy. It's clear that it's only active and profitable in certain market conditions. If these conditions are not favorable for this strategy, it simply loses money. For example, during these 3 consecutive years, the strategy lost. It made a little bit in the first one of these 3 years, just to give it back in the following 2 years. This is exactly when most traders who do not understand the nature of the strategy would stop trading it, just to see it having a record run up in the following year, 2018. This strategy clearly has an edge, but only in limited circumstances. For instance, it made almost 40% in March 2020, which was a really bad month for long-only stock strategies in general. After that, its equity went down for the rest of the year, and so that 1 month saved the strategy from having a losing year. This makes perfect sense, as the strategy focuses on a very specific type of market, which makes it unsuitable to trade it in isolation so as a single strategy. And this is where many people stop, scrap the strategy, and go looking for something better. I get comments like these quite often here on YouTube on some of my videos where I share a particular trading strategy type, such as mean reversion, for instance. Some people say, well, that's only going to work in a ranging market and lose in trading market. And that's exactly right. That's the whole point. It's exactly how it should be, as you simply can't have a systematic strategy that works under all market conditions. The point is to take that strategy and combine it with another one that will likely be profitable when the first one is not. So let's see how that's done. Let's see what happens when I do that with this volatility strategy. I've now added a second strategy. Its equity curve is plotted in blue. This is a momentum type of strategy that trades stocks in Nasdaq 100, and so it naturally suffers during periods of high volatility when the stock market is falling. We can clearly see that these strategies are of a different nature. The grey equity curve is visibly far more volatile and has periods during which it is not active, whereas the blue equity curve is far more active as the strategy is invested in the market more consistently. Now, why would I want to combine these two particular strategies? It's simple. It's because of their low correlation to each other. In fact, the daily returns of these two strategies are negatively correlated, which makes them a perfect fit. In other words, this means that when one strategy is losing, the other one is highly likely to be gaining. By doing this, we're thinking on a portfolio level rather than on a single strategy level, which is an absolute key when it comes to systematic trading. I've zoomed in on the equity curves so that we can see the effects of negative correlations of these two systems. In this area, for instance, the blue momentum system loses and gets into a drawdown, but look at the volatility system. It has a huge run-up as it gets a couple of profitable trades and offsets the loss of the blue system. The blue system then has a prolonged losing period, 2018/2019, which was generally a bad period for trend following and momentum systems. But again, the orange equity goes up. And more recently, beginning of 2020, which was a very bad period for any longer term, long only stock strategy, look at the huge drop in the blue equity. These drops are hardly avoidable in reality. And so instead of thinking about what additional filters to implement to this particular strategy, it's a much better idea to instead think about what additional strategy to combine it with. Look at the massive run up in the orange equity. It offsets the loss of the blue system, which is exactly what I wanted to achieve. If I now go back to the original volatility strategy's equity curve and display it alongside a combined equity of the two systems, the difference is very, very significant. The turquoise line, which is the combined equity curve of both systems from the previous screen, is visibly much smoother and consistent, and that's exactly the point of combining strategies into a portfolio. This kind of approach is therefore very different to thinking in terms of a single strategy, and is something that no beginner does. You will never have a single strategy that will be perfect in the sense that it is profitable all the time. That's simply a pipe dream. When thinking on a portfolio level, I'm not really bothered by the fact that a single strategy is not perfect, but I rather focus on what really matters. How does it improve my overall portfolio? And let's have a look at that. This is a portfolio analysis spreadsheet that I built in Excel VBA and used for my own analysis. Now I've plugged in two strategies I've gone over in this video, traded alongside each other, where the capital is split 50-50 in between them. The average annual return is at 14%, which is slightly lower than the original 16% of the volatility strategy on its own, but that's only one side of the equation. The other side is the maximum drawdown. The maximum drawdown went down from 31.5% to 16.2%, which is a decrease of just under 49%. The average annual return has decreased only by 15%, which, when combined together, is a significant improvement. Also, the overall consistency of returns went up as well. This was clearly visible on the equity curve of two strategies combined that I've just shown on the previous screen. The number of losing years went down from 3 of the volatility strategy on its own to 1 when combined with just one more strategy. And this is the final monthly equity curve of these two strategies combined and compared to the SPY. I think that the benefits of combining strategies are clear. This is, in my experience, something that can truly elevate your trading to a whole new level. Now, this was just an example, and I personally like to combine more than 2 strategies. I currently have 5 different systems in my portfolio and looking to introduce even more. But just by combining your existing strategy with another that's different in its logic and risk profile will be a huge improvement, and I highly recommend that you start looking into this yourself. Jumping from one strategy to another is simply not the way to go. Hope that you enjoyed the video. This is David at Critical Trading, signing out.